Bomba-dee-da, 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 bomba-dee-da,
Hey,
Welcome. How we doing?
welcome back,
Good to
and
have you back.
happy
Happy
trails.
trails. And I mean, the first question, the pressing question that we have for everybody is, how are your ducks? Are
Yeah,
they in a row
or
yet? Or are they
or
scattered?
which way?
You don't want them
You know,
scattered. We
you
talked about this.
you want them
Everybody
in a
out there,
row. You want them in a
get
row.
your ducks in a row.
You threw me with that question because I thought
Oh,
you were going to say the first question is who's got your
gotcha.
money,
That's the second question. Right.
and the second law of questions is who's
Yeah.
got your money.
Uh,
You fools,
right,
you
right.
crazy fools. Oh, hi,
Oh
Chris.
man,
How you doing?
your dog's joining you. Are we interviewing your
Yeah,
dogs today?
yeah. He's got a lot to say. He says
Good.
everything is poop. I don't know what it is for some reason, or maybe that's just
Uh,
what he smells like. I don't know. It's fine. It's good.
nice,
You know
nice.
what I love is when your dogs come up and breathe right in your face,
Yeah.
and they're probably just licking themselves. Like it's just like a nice fresh. Oh, wakes you up. Wakes you up.
Wow, that's better than them licking your face.
True, because that would be a terrible thing. So
Man,
hey,
yeah.
happy trails,
All
everybody.
right,
Welcome back.
lots of exciting stuff going on down this
Oh
week.
man, we got some cool stuff since we talked to you last. Um, One of our mentor and the person we follow, Brad Sumrock, has given his forecast for 2024, which is a very special event that we both listened to, and some good insight through that because basically Brad's the one that brought us into the ecosystem and introduced us to a lot of different people and brought us in and taught us his method, and this is how we've been proceeding with our investments. This is what we're teaching to all of you that are listening along the way, inclusive of some of the things we've learned along the way with him and other people. And we also have not only the forecast that he's given, we have some insight and some really big news, right, Blaine?
Big,
What's
big,
that big? What's that big news?
big news coming from Congress.
Yes. Can
Yeah.
you believe that there's big news coming from
I
Congress?
know. It's actually, what's really amazing is that Congress is actually doing something.
And what's amazing is we're talking about it in a favorable light,
Oh
which
man,
is
man,
really
man.
interesting.
All right, all right.
It's
So Matt is going to describe again the what bonus depreciation is, and that is kind of the big news coming out of Congress. There's a bill going through Congress that is going to put our bonus depreciation to back up to 100%, and it's going to be retroactive for the last couple of years because it was at 100% 2 years ago. It was at
yep,
80% in 23. 24 was supposed to be 60%.
yep.
And they're like, nope, we're putting it back to 100. Tell them about bonus depreciation, Matt.
Boom. So another name for bonus depreciation is accelerated depreciation, Blaine. So accelerated depreciation is when you basically have the ability to write off your depreciation. I had a little hair on my computer. Write off your weird, and the depreciation from your investment, things that are coming about in what is done normally as a cost segregation. So cost seg needs to be done on property for you to be able to accelerate the depreciation costs. But let's say you have an apartment complex that you purchased for $1 million. And let's say within that $1 million, all the depreciation things like, the appliances and the light fixtures and everything else that's inclusive in this apartment complex depreciates at a rate of normally, I believe it's 27 and a half years is normal
Yeah, it's something
depreciation.
weird.
So you write off a certain amount every year for 27 and a half years. And
You take $1 million. If they
if they,
decided there was $1 million of stuff to depreciate, actually, you
it's
have your
usually
land.
right. It's usually
Land in there,
less.
yeah, yeah. Your land in there is worth something and doesn't depreciate. So if you buy something for $1 million, the government, or I don't know if it's a government, some tax lawyer will go, hey, you have the land's worth 200,000. So you only have 800,000 you can depreciate over your 27 and a half years. So you take 800,000 divided by 27 and a half, and that's what you get to write off your income.
Correct. And there's things that you can, like you said, you can write off, things you can't write off. So in the end, that just totals what you've been able to do is write it off over 27 and a half years. And with accelerated depreciation, you can take it immediately year one. So, and that is also used against your active income, Blaine.
Yeah.
So what a fantastic way to save on tax savings. So this is why you're seeing these apartment deals. This is one of the things that really attracted us to investigating multifamily real estate. This is really where the tax game gets played, and this is where all the people that you see that have the money in this world, they're all invested like this. And you got to stop and wonder, if they're invested, maybe I should check into this. Well, we started to check into this, and it's led us down this rabbit hole that we're in currently. And but anyway, so bonus depreciation has gone through the Congress.
It's either the
Gone through the
House or the
House.
Senate. It's past the House, I think.
It's past the House. It's got to be put in front of the Senate, of which they're talking about they're already going to pass it, but it just depends when they adjourn again or when they reconvene. I mean, Ann seems to think that's sometime in March. So, and I'll trust Ann because, you know, if I don't, she'll hit me or something. So, yeah. But so we think we're March, and but what a great thing. I mean, imagine just bringing that back. That had such a tremendous impact on the multifamily real estate game, but it had such an impact on people's tax savings and wealth. I mean, instant net worth increasing, really, really big things. This is where the sausage is made, people. And you want to be in that room, trust me. You don't want to be left out. So
yeah, it's time to make the sausage.
Making sausage.
Isn't that donuts? Time to make the donuts.
I'm not really sure what you're talking about, but sure.
That's it. We'll call it a Donut Land commercial.
I love
we have
donuts.
Donut Lands. We have Donut Lands around here, and the owners we know. So anyway,
you know I love donuts.
Yeah, you can tell.
Donuts. Yeah. That's awesome. Yeah.
All right.
Okay. So
not this year. You don't.
No,
because you're sticking with your intentions. And
I haven't eaten many donuts. I gotta be honest with you.
Good.
But if you put a donut in front of me, it'd be a fight.
I bet the donut loses.
Especially a maple frosted donut.
Oh, with bacon on it?
I don't care if it's bacon or not. That doesn't really do much for me. I'm kind of a nostalgic guy, you know, like the regular stuff. You know what I mean?
Yeah, I like the old fashioned.
I don't need all these. I don't need donuts with Fruit Loops on it and stuff like that. You know, just give me the donut.
Right.
Anyway,
man. All right.
Who's got your money?
Who's got your donuts?
So, and are your donuts in a row?
I don't want scattered donuts.
Or where are they?
Oh man.
Anyway.
Awesome.
All right. So that's bonus depreciation.
Yeah, that's
the best way to think about it is accelerated depreciation. So accelerated from 27 and a half years to immediate year one. That is a big deal, guys.
Yeah. And most of that includes your CapEx. So if you're going to put, if you buy a property for $1 million and you're putting 200,000 of CapEx in it, bam, that's instant write-off.
Yep. So just imagine, I mean, I'm just imagining that there's people out there listening to this like me, who, when they first heard that, were like, what's bonus depreciation? Never heard of that. Didn't hear about it 2 years ago. Didn't hear about it a year ago. Well, I did when I started going down this rabbit hole, but had no idea what people were talking about. And I'm imagining when I talk about this to other people, I get the same dumbfounded look that I gave people back then. It was just kind of like, what? Yeah. I have no idea. What do it, Blaine? Yeah. Give him the look. What is the look?
Huh? What? Did everybody pick that up? You can't. Maybe they could, if they're not watching, they could maybe feel that look.
Oh, you could. What? Oh, I felt it. What? I felt it. Yeah.
Okay.
And you're making the face in your car as you're listening, I'm sure. And if you're not, you should try to make the face and just see if it works for you.
Yeah.
Because I'm sure it does. But so that's a really, really big deal. And that's really first and foremost, because that's actually national news. And that's really cool. So if that does get by the Senate and it gets passed, man, that's going to make a landmark change for all of us investors. We didn't necessarily, Trump, that got enacted when Trump took office. And when Trump took office, that's what he put into play. So, and it was 100% up until 23,
Yeah, 23 was
22.
80. 23
Yeah.
was 80%.
Yeah. So it's changed, but that's very, very cool. So onward from there, let's talk about the 2024 Brad Sumrock
Forecast
forecast.
for real estate. And one thing I wanted to point out, and Brad pointed this out when he first started, he's like, I'm just not like making this up or guessing at this. He goes, I've looked at like 16 or 17 of the big dogs across the country. I've read their reports and I compile all that information together, put it in a thing, and go, hey, out of the 16 people, 14 believe this is going to happen. Pretty good chance it's going to happen. And so he kind of combines all that and then dummies it down for us and then lets us know what is going on. So these are not necessarily his thoughts, but this is his what he has gleaned from a whole bunch of other bigwigs in the country that do real estate.
And I think if you want to watch the forecast, I think you could still get on his website. That's www.bradsumrock.com. And right on the front page, I think he has the little webinar that he gave that you can sign up for and get for free. So you'll get other emails sent to you, but you can disregard if you don't want to be a part of it, or if you do, now is probably a good time to look into it. So we're going to go through the forecast and kind of things that we heard and things that we see and apply to our lives. And whether you want to go watch it with Brad or just listen to us, you take it as you will. So.
Well, we talked last time about how much more retention there is when you listen to us.
Well,
76.3% retention.
I think it was 76.37%.
That was the study. That was the study that was put out last week.
Well, we are the fastest growing real estate podcast that's out there right now.
know it.
Hey, tell your friends, share it with everybody, and you need to help us grow this. This is really, this is what we're trying to do.
Because,
so there you go. So, Blaine, start us off. What do you want to talk about first with the forecast?
Nothing too shocking. I mean, the other thing that happened last week is that the Feds met for interest rates and they decided not to raise or lower interest rates. They're like, we're going to keep them the same. And I think that was pretty well predicted. Most people didn't think they'd do anything with it. They're still hinting at lowering interest rates as the year goes on. And that's what, that's typically, and that was one of the things that Brad talked about is he gathered all this information and the guess is 75 to 100 basis points drop in interest rates, or up to 1% interest rate drop this year is what everybody's predicting. So I think the Feds meet, I don't know, they make like 8 times in the rest of the year or something like that, and they're expecting them to drop it a quarter point maybe every other time or something. So that is something.
Where are we at right now? We're at what?
It's 5.25.
You're the 5.25, right?
Yeah, is the basis.
So the thing that Brad showed, and I thought was interesting, and I wrote this down, is by the end of 2024, the interest rates by the Fed are predicted to be at 4.6. At the end of 2025, they're predicted to go down to 3.6. So I think if that's the trend, and based on the graph and by the information that Brad showed with consistency along the way, I think we're going to be probably right on that or pretty close. So I'm just saying, hell, if we can drop down by the end of this year and be anywhere in the mid 4s, that would be fantastic. I'd love to see us in the, right at the edge of the 3s. That would be even better. So who knows? But if by the end of 2025, we're sitting in the 3% range, man, that's still amazing. But again, I just want to emphasize, so what? So what if it's 8%, guys? I mean, how many of you are paying on 8% on your house? I mean, you didn't get in your house, I guarantee, at 3%, not when you bought it 20 years ago. So you had to go back and refinance or whatever.
Mm-hmm.
So What about back in the 80s when it was what 20 something percent,
Yeah.
18,
18,
22%?
20% or something like that.
I mean, everybody still lived their lives. They still worked. Everything was fine. So yes, it makes things easier when they're lower because of the trends that are going on and allows us to invest. And one of the things you're going to see is as these rates continue to stay high, there's some really cool things pointing in the direction of multifamily. And we're going to talk about that here in a minute because that's what created this really big boom for us in the last couple of years.
Right. Exactly.
Well,
And it's coming again. I mean,
let's just hit on that. Let's hit on that again.
everything-
Let's just hit on it right now. Let's hit on
everything,
it right now.
everything cycles.
Yeah.
No.
Did you have a graph? Are you showing that graph?
I have a graph. I can show it, I guess, if you screen share. But so this graph just it's understanding the investment cycle, and we'll and it is basically the shape of a clock. And
Yeah.
so at the top you have and apparently we're not going to show it because
Hey, hold please. Boom. Look at
Okay,
that.
I think we're sharing. All right,
And you
here
know
we
what?
are.
You know what, Blaine? Sharing is caring.
Caring.
Yes.
And we all know how much we care.
There you go.
Yeah, right on. All right. So this is kind of interesting, and this isn't necessarily designed specifically toward multifamily. This is kind of any kind of investment. But at the top, this does have real estate prices, but at the top at 12 o'clock, we have rising real estate prices. And if you look at what happened in 2 years ago, 2022 was the peak of the market as far as pricing goes. And so everybody was paying a lot because interest rates were low and you could afford it. And, and then you go over to 1 o'clock, between 1 and 2, and 1 o'clock is rising interest rates. Okay. Well, we certainly had that the last couple of years.
Mhm.
So, you get rising interest rates lead to 2 o'clock, falling prices, whether it's, your multifamily or your house or whatever. You're going to get the prices are going to start dropping. And then, you come down to the bottom and money's getting tighter. So
look inside, Blaine, look inside the circle there. What does it say right at 3? Corporate failures.
corporate failures.
What did we see when the rate started to dump? When they started to go sky high?
We saw banks.
We saw
There were banks that
banks.
were
We saw
failing. Yeah.
we saw companies going under that you wouldn't believe they were folding. We saw banks that were folding. So this is a really big deal. Go ahead.
Yeah. And then you get to a whole slowdown of the economy.
Mhm.
And I know we've been talking about that for 2 years. How is it going to be a recession or not, or what's going to happen? And so everybody gets all sad and gloomy, and that's the next part.
Money gets tight.
They're gloomy, and money gets tight, and so nobody's investing, and that's happened last year. The end of 2022 and into 2023, the number of real estate, multifamily real estate deals went way down. And I think it was the least amount since 2012. I thought they said.
Yeah.
And that was another little economic crisis there. So, money's tight. And then of course, then at the bottom of this is number 6, you got falling real estate prices. So your real estate, prices start to come down because people can't afford to buy them. And you're like, hey, and some people are distressed. They're like, we got to sell. Our loan is up, I got to get out of this. And that's kind of what we're seeing now and over the next year. So I would say we're pretty much at the bottom here, and on our way back up to the other side. So the next step after real estate prices fall, we have falling interest rates. Well, what are the feds talking about? We just went over this, right? They're talking about dropping interest rates, and that starts the recovery. That's the recovery part. And then your prices start going up, and then eventually money gets easier, and the more deals go through, and then your real estate prices increase because people are wanting to buy, and then you're at the top of the clock again. So we're somewhere down in the bottom where we're, between 5 and 7.
Yep.
And Brad showed a graph very similar to this. And he's like, the time to buy is somewhere down in the bottom. That's the best time to buy. And the best time to sell is at the top. So if we're here at the bottom, anywhere between 5 and 7, when do you want to buy? Now. If you can find the deals, now's a great time to get involved and get going. And, I think we talk about how real estate can be done at any time in any market, and you know, it's a kind of a hedge on recessions and stuff like that. It can still work. But so, again, great time to buy now. And we're waiting for deals to come across. And that's kind of one of the other things we've been talking about, how we think there are going to be a lot of distressed deals this year.
Mhm.
Well, Brad kind of said the opposite.
Yeah, I was surprised at that. And
I was,
I've started to think about that too, Blaine, because I'm thinking, I think Brad's full of shit on this one. I think he missed the boat. But then I started to think about it, and he may be right, because there was one of the things he said is that the FDIC is coming down on top of the banks and saying, hey, you need to give better loan consideration, giving guidance with loan consideration for all these people that might feel distress on these deals. We need to give them some consideration on how to maybe modify that loan agreement and that arrangement so they're not scrambling and going to fall out from underneath them. So
Yeah.
if FDIC steps in and starts granting people some leeway, some in their potential to pay the loan back, then I think he's absolutely right. I don't think we're going to see that kind of a fire sale that I thought we were going to see, and we've talked about for the last year.
Yeah.
So,
Yeah.
and
That was
that's
kind
a
of,
cool thing.
yeah, I didn't think they would do that. I think that's an interesting take on that. It's, again, kind of unpredictable that the FDIC do that, but
Yeah.
hey,
I think one of the things that he said that really caught me at the beginning is he said that the affordability gap is at an all-time high. And the affordability gap in housing is kind of like the difference between buying a house and paying rent. This distance has become at an all-time high. The difference in buying a house that you can entry-level house and you can entry-level apartment. So when it's like that, what happens is it prices people out of the housing market,
yeah,
and they have to go to apartments. Well, we all know that when we jumped in this 2 years ago, there wasn't enough apartments out there to house the people that couldn't afford the homes. So what that does is those class A apartments that are offered at a premium, almost like a house payment, they can't afford those either. So these class B and class C apartment styles that Brad has taught Blaine and myself to look at in particular, the ones that we go in and we do a value add and we upfit and raise rents, usually at a typical 3% per year, something like that with steady income growth, has shown great returns in the past in formula that he's been teaching his students for over 10 years now. So that affordability gap is something that he also said is a trend that he's looking at in all your big cities. Part of his cities where he's picking his properties, it depends what he's looking at, and the affordability gap is one of those. So I think it's really interesting that he said that, because I think this is still in our favor right now, especially if the FDIC gets in there and jumps in with these, what I thought was going to be fire sale properties. There's going to be some good return coming on these for them and for the people buying. So it's not going to be distressed. That's a good thing too.
Yeah, and I think that they mentioned the one thing that could derail the B and C properties is if there does become a recession and you get a lot of unemployment, because
Yes.
our properties are used, and we're trying to create these nice living places for the working class, right? Families that are making 50 to 100,000 a year are living in our places, and if they get laid off and don't work, then they're not going to be renting, right?
Yep.
I mean, they
Yep.
still need a place to live, but they'll find something less expensive, or sometimes they'll house up with other people or go live with their families or something like that. And that could hurt occupancy on our B and C type of apartments.
Yeah. And I think you see the difference in the B and C and the A's really is working class versus kind of a luxury class.
Yeah.
There might be people that are working high-end jobs and they're traveling quite a bit. They don't want the maintenance of a house, so they just have apartments, or they have condos, or whatever you want to call these things. But either way, they're paying higher premiums for really nice type A properties, which is totally different than what the working class is paying for. So I think that's showing up and continues to show up in what's happening in the trend as well. So, what else you got, Blaine? I took some notes, actually. Believe that.
Well, I was the other thing was, Brad listed his top 10 markets for the year.
Yes. Yeah, I thought that
And
was
I'll
interesting.
run those down. I'll run through those here. Number one, Dallas Fort Worth, as it has been forever. And that's just
And
because there's a ton of job growth, ton of population growth, and
ridiculous. Like,
very friendly.
And
Laws and
the
rules.
scale, the difference in the jump between 1 and 2
Yes,
was
yes, is like
crazy.
huge. Yeah.
Crazy with the amount of growth that's happening in Dallas Fort Worth. I'm amazed every time we go there, man. I had really grown to kind of love going and checking out Dallas, to be quite honest, because
Yeah,
it's kind
yeah.
of fun. But I mean, there was a drastic difference in the job opportunities and the properties that are available. I mean, it's really an expansive jump between 1 to 2.
Yep, yep. 2 is Tampa. 3, Houston. 4, he put Southeast Florida. That's like Miami, Fort Lauderdale area. There's multiple cities down there.
Yep.
5, Salt Lake City, Utah. Lots of population growth there. I think that's a lot of West Coasters are headed to Salt Lake City
They're
to
getting out.
get out of California.
They're getting out.
6 would be Charlotte, 7 Vegas, 8 Raleigh, 9 Indianapolis, and 10 is Nashville.
Nashville.
Nashville. So he dropped off from last year. He dropped Phoenix off the list, and he dropped Atlanta off the list in
And?
like Orlando.
And
And
there was an up and coming market, Greenville.
Greenville.
I did mention that.
He
Greensville's.
didn't. No, nope.
I liked how you said 6B Charlotte. Like ahoy, 6B Charlotte. Like you're a pirate.
Did I?
Pirate Blaine.
Oh, matey.
5 is Salt Lake City. 6B Charlotte. But what she know?
Oh man.
What concert you go to last night? What was it called?
The Pork Tornadoes.
The Pork Grinders.
Pork Tornadoes.
Pork
Good
Tornadoes.
stuff. Good stuff. Good local cover band. They were awesome, man. They're so fun. They should hang out with the Atomic Punks. That's who they should do. They should get together and tour
nobody.
together.
So you gotta do something if you're gonna compete with the Punks, man. The Atomic Punks they're awesome, brother. They're touring I think right now they're just running through California, but man, I want to go out there with the buddies and that we grew up with and just go invade their concert somewhere, and they're so much fun.
Yeah.
If they get near you, you got to go. I'll fly out. I don't care when it is. I'll fly and fly back. Yeah, it's a good time.
So, what else? I think those are kind of the main points.
He had a couple things to say about his assessment. So one of the things that he said, Blaine, was instead of looking in these primary markets that we're all used to, be looking in some of the secondary and tertiary markets for higher yield. Like he said, he got involved in a property in where was it?
Abilene, Texas.
Abilene.
Yep.
He says, why the hell did Brad look in Abilene? Because the yield was higher and it's definitely a tertiary market.
Yeah.
So there are secondary and tertiary markets, just like I thought Greenville was hot. On his top now is Raleigh. And Raleigh's growing just, I think, with all the industry that's moving in that direction. So I've been up there. I got some friends that practice up there, and Rob and Bobby Stanley are up there, and Bobby Elliott's up there. So, I mean, we got some good friends that are up there, and they always talk about how busy and how crazy the growth is up in that area. And it's wild, man. It's kind of like when I'm driving up there. I was just there last week, and it seemed to be a lot like the big growth that's going on everywhere else. So, he also said the value add is back. There's a period of time where the whole marketplace with your B's and C's were questionable, and now value add is definitely back into the trend and into the market. You already talked about how the flood of properties for the distress is probably not going to be as high as it was. Still waiting to see that. I'm waiting.
I think some of that has to do with the fact that if you don't have to sell, nobody's just going to sell.
Right.
Normally they have people are like, okay, we've been in this 3 years and it's time to sell this and get our investors their money back. And nobody's doing that now. And so you have to distress people. But if you're not having trouble, you're going to ride this for another year. And so that I'm sure that lowers a lot of the transaction numbers down.
The other thing you said was that returning to historical norms pre-COVID, because when COVID hit, things went through the roof like crazy.
Yeah.
And then
crazy.
Crazy that you've never seen in the market before. So they're predicting that kind of things, and with everybody he knows, it's going to kind of go back to the norm of what it was before COVID. So that's kind of the basics of that.
Yeah. Yeah. So nothing crazy. It was good though.
Yeah. I didn't.
Good to hear.
I
we'll
think,
be,
yeah, I think what we'll do next time, Blaine, we could talk about this, talk about market selection, some of the things we look for when you're trying to pick those markets, some things we can expand on, which would be a good thing. We could talk about that in the next coming weeks,
yep.
which would
We've
be
gone over
good.
some of that before. That'd be great though, because we
Yep.
know that repetition is the second law of learning.
Yes, sir. Yes, sir.
You catch
Second
that?
law.
Repetition is the second law of learning.
Well, you said it twice. That's repetitive, I think.
Yep.
I just learned it twice, just right there.
Repetition is the second law of learning.
That's
Yeah.
good.
See, you
Good,
guys are
man.
remembering this now.
You guys are amazing. I know you're sitting out there going, did his tape get stuck, or
This
is
is
it,
tape. Did the record skip?
did the record
Did the
skip?
needle on the record skip and go
Did-
back?
Is there anyone out there that has no idea what a skipping record or CD is? Raise your hand right now. Yep, I see you.
Yeah, there you
Yeah,
are.
no idea what that means.
That's too bad.
Try that with your kids. They look at you like, what?
Hey, and that reminds me of the story. This one little girl, this friend of mine said, "Yeah, my niece came up and she looked over on the counter of this house, or I don't know if it was a house or hotel, and she's like, 'What is that?' And they're like, 'Well, that's a phone. You like, you pick it up and you dial a number and it's how you call people.' She goes, 'Well, how do you take pictures with that?'"
Hey.
We think that's funny, but from her
I got news
standpoint,
for
she's
you.
like,
Thank God we did not have cameras back in
"Oh,
our day.
isn't it wonderful?"
Thank God. You know what?
Woo-hoo.
That's a blessing. And for those of you out there listening, it's a blessing for you too. Don't deny that it's not, because it is.
It is.
So cool.
Okay.
Well,
That
that's
it?
really good.
Wrap
Yeah,
it up.
that's some good stuff. That's it for today's episode. Let's talk next week. We'll throw some new stuff at you. That might be repetition, but some new stuff for people that are listening. And guys, again, share the podcast. Send us your questions. Had a couple people tell me, "Hey, I just started watching, really starting to enjoy it." And I'm like, "Well, good. Keep up with it. It'll grow on you like like a cyst or a wart or something." Anyway, so hey, want to thank you guys for listening, and
Happy trails.
happy trails, everybody.
Everybody, enjoy.
Who cares about the clouds when we're together? Just sing a song.